Hi there. In today's video, we're going to take you step by step through the process that we would run through when we look after our clients' management accounts. So whether you are a bookkeeper looking after your clients' accounts, or whether you're a business owner preparing your own month end and preparing your own accounts, this step-by-step process will work for you in your business to get you some magnificent month-end management accounts. So let's just swap over and share our screens. So this is the process that we use in our business. So we know it works. We've built this up over some time, and it's a standard process for all clients, although of course some deviate slightly depending on their complexity. They might have more of a sales field, they might have more credit cards, less bank accounts, that kind of thing. So feel free to adapt this to fit yourself, but here we're going to walk you step by step through the process that we use.
Now, this month-end management accounts checklist has got printable, so if you do want to print it and laminate it, you can. If you want to work through it on screen, that's also available. But the first thing we would do in every situation, regardless of whether you're the director managing your own accounts or whether you're the internal bookkeeper, first step we do is we reconcile all bank accounts. So if you're using an accounting software such as Xero or QuickBooks, run the reconciliation reports in your accounting software and check that the statement balance actually matches the balance showing on your bank statement. Because if it doesn't, we'd need to check and investigate any reconciling differences here. Because it might only look like it's a few pennies out at the end, but it might be that actually along the way it's missing multiple
but what
transactions.
you often find is if it's a few pennies out, it's often a big transaction one way and a big transaction another, or several transactions in between. If something goes wrong with a bank feed, it often tends to be a day or two or three's worth of transactions. It's very rarely, sometimes can be, but very rarely just one transaction.
And usually when it's just one transaction, it's just one transaction on that day because that's the only thing that's happened in that day.
So check and investigate any of your reconciling differences. Follow up with any uncleared checks. If the uncleared checks are under 30 days old, they're probably just tardy and sitting on somebody's desk somewhere. But if they're up to 60 days old, it's quite often possible that they're lost. So contact the person who you've sent the check to or you've received the check from and find out what's happened in that instance. So quite often checks are paid in by your own suppliers. I mean, we don't tend to see checks that often nowadays, but if they come in, you'll get a remittance advice to say that a check has come in, and then you've perhaps got it in your own desk or it's in your assistant's desk, that kind of thing. It's a pain in the bum to get them down to the bank nowadays. So have a look for those. So if you've sent a check out and it's more than 30 to 60 days old, then you might need to reissue those, or you might need to look at another way of making that payment. So check that all the bank balances in your accounts match your balance online. And this is super important, as we've just said, because sometimes transactions are different. Now, even though we rely on our bank feeds to work efficiently, you still need to check them once a month or at least once a quarter to make sure those balances do reconcile to your closing bank account.
And why do we start with bank accounts? Because it basically drives many of the transactions in the system. So you'll be allocating it to age payables, age receivables, you might have direct postings. So basically the transactions are derived by what's in your bank. So if you haven't reconciled it, your accounts won't be up to date. So that's why we always start with bank accounts.
Now, we do see in quite a few clients' accounts that transactions are not always reconciled because you're waiting for some information or you've got a query on it. But what we would recommend is, instead of leaving it unreconciled in your bank account or in your bank module, you post it to a queries account in your profit and loss account. So your profit and loss account always shows the worst case scenario of cost. If you find the receipt later, then you can adjust for VAT if you're VAT registered, and that will reduce the cost in your account slightly, but it still means that you've accounted for that query. Even though you might not necessarily have it in the right place, it's still in your profit and loss account. Don't put it into a suspense account in the balance sheet. That's not the right place for it to go. If it's something that you've spent, it's most likely a profit and loss account item rather than a balance sheet item.
And it's usually just a missing invoice in that instance.
Yeah, usually.
So at least you've got the worst case and you provided for it. And the next bit.
Next step is to reconcile all of your PayPal, Stripe, factoring or loan accounts. And if these are usually set up as bank accounts in your accounting system, you reconcile them in exactly the same way as you would a bank account.
So credit card and factoring accounts may have a negative balance when you're actually looking at it, just as a little pointer. If you do see a negative balance, don't be alarmed that it's necessarily wrong, because credit card balance is a liability, not an asset.
Yeah.
So that's one thing that does often spook people when they first look at this. So credit card and factoring accounts will have an opening and closing position that you can reconcile to. So you should be able to access a statement online or a printed statement. However it's accessed, you will be able to access those figures.
But the thing to watch out there is they're not always month end. So quite often they run mid-month to mid-month. So you need to look at your accounting transactions and your bank reconciliations or your card reconciliations to and from a midpoint. So if you're using a software like Xero, again, that's quite easy because you can run transaction and reconciliation reports to and from other dates than month end. So that's quite simple.
Yep. And check for the transaction fees in those, because they're usually the ones which cause the accounts to be slightly out of kilter.
Yeah.
So just check for those ones. And also be aware, if you are repaying a loan, your monthly repayment, say you're repaying a loan at $750 a month, some of it might be capital, some of it might be interest. So it's not just a flat £750 repayment of the loan capital. It might be, I don't know, £700 plus £50 worth of interest.
And that might change over time. So always get copies of loan account statements at least once a year to make sure that your ending balances match what's on your loan statement.
Yeah, because they almost always, you often get that.
So check that all of your VAT returns have been submitted and paid. Now that seems really obvious, but again, this is an error that we often see in clients' accounts where VAT returns are perhaps published outside of Xero, and that's less likely to happen now we're all MTD. But sometimes the VAT returns are published outside of Xero through a bridging software or through a different software, and then the VAT return in Xero or your accounts doesn't necessarily match what you've submitted. With MTD, this should be less likely to happen, so you should have everything published from your accounting software. So if it's the end of your VAT return period, check all of your invoices and cash receipts are posted to ensure your balance sheet has the correct VAT liability. Now diarise that and make sure that you pay it on time, or better still, sign up to pay by direct debit. So once you've filed your VAT return, you don't need to worry about it.
And make sure to set that cash aside.
Absolutely.
So if you've got another bank account, Waterfall, it literally isolate the cash so that it is available for the liability, which is in approximately 5 weeks' time if you're looking at it from the month end.
Yeah, so it's usually 1 month and 1 week after the end of the period, isn't it? So reconcile your age debtors. Make sure that all of your month sales invoices are raised. Again, this sounds really obvious, but you'd be surprised how many clients we see where they haven't got a process in place to make sure that all of those sales are raised each month on time and in full. Check and chase any outstanding customer debts. It should be doing that weekly rather than monthly, but give them a clean sweep at the end of the month to make sure you've captured everything. And then check the age of the debtors. Do you need to put any of your clients on hold? Do you need to refer any to a debt recovery agency? Do you need to escalate the chasers in any way?
Now, I wouldn't assume because your bank is fully reconciled that your age debtors is fully reconciled by default. So one of those things that happens is people reconcile the bank, they forget about the debtors and actually looking into it because the bank's all up to date. But it's a slightly different kettle of fish.
Yeah, it's
there
a
might
good
be
time
other
to
things going on.
chase.
So yeah, good time to check, good time to chase. And then after we've reconciled age debtors, we would also reconcile age payables in pretty much the same way. The difference with age payables is actually you can request statements of account from your suppliers for these to check if you're missing any invoices. Failing that,
and sometimes you get them automatically, don't you? And what we see happen with a lot of clients, they don't necessarily use those. You'll receive a statement, they'll file the statement, ignore the statement, but that's a great opportunity to make sure that you haven't missed anything and you're not going to get chased for anything later on, and that your accounts are up to date. So if you do receive a supplier statement, do check to make sure that it reconciles to all the invoices that you have on your accounting system and make sure you captured everything.
A statement email is actually an actionable item.
Yeah.
Check it against
Put
your
it
system.
in your workflow.
Make sure it's correct. and then you can file it away. But failing that, if you don't have a statement of account, you can always request one, or you can also request an activity statement if you're not entirely sure which invoice you're missing and it's just showing you the overdue balance. Then you request an activity statement which will show all of the invoices and all of the payments, as long as the supplier's good to do that.
So check that you have posted all of your purchase invoices received. Quite often you'll find them on your desk, in your in tray, in your email accounts. So use things like Receipt Bank to post all of these transactions for you, and set up rules from your email account to push the invoices as they come in directly to your Receipt Bank, and then that'll push them into Xero or QuickBooks. Check that you haven't received goods or services but you've not been billed for it yet. So do you need to ring your supplier and ask for a copy of the invoice? Perhaps again it's stuck in your email, or it's stuck on a pile of paper somewhere. Check your supplier statements of accounts, and check your outstanding balances and age of debt. What might you need to pay and when? That can help you understand your cash flow a little bit better. And then the other thing that you need to do is check your age payables and make sure you haven't got things on there that are outstanding, like Tesco's or Amazon, or a fuel receipt perhaps, that you know would have been paid for at the time of purchase, but you haven't shown as paid in your accounts. It could be that you paid that personally, or you've paid it on a credit card or a debit card or a different bank account, and it hasn't properly been reconciled in your account. So always scan your age payables and look for things that don't look right. It could also be that it's a duplicate. So quite often when we see little items like this that aren't paid, it's because they have been paid, but they've gone into Receipt Bank or Xero twice, and one of those needs to be deleted and voided.
So there's a lot you can benefit from with age payables and age debtors. So definitely do not overlook these ones. They are really, really important, and they can reveal quite a lot actually. So the next one is to look at your fixed assets and check that you have capitalised any new fixed asset purchases. So have a review of your P&L to see if there's any items in here where you think, actually, I've coded this to office equipment as an expense, but actually it's an asset because it's saying it might be £1,000 computer. So check for those items first. Make sure that they're actually recorded in your balance sheet, not in your P&L. And once you've got your fixed assets up to date and you've checked that you've capitalised them all, you would then need to look at running depreciation. So post depreciation for the month to ensure that all of the costs of running your business are already provided for. And if you are using a software such as Xero, you can run the fixed asset reconciliation report just to check that all of your assets have been registered. So that's
and
a
at
really
the right
good
value.
Report. Yes.
So a common error that you often see in clients' accounts is that the asset is paid for gross, so including VAT. The cost of the asset will be the net amount, so say £1,000 plus VAT. But then when the asset is set up, we see sometimes that the asset is set up with the gross amount. So it might be an asset set up for £1,200 when the net price paid was £1,000. And of course, because we recover the VAT, we wouldn't include that in our asset price in our fixed assets register. So check for that and make sure that that all reconciles, and the fixed asset reconciliation report will help you do that.
That is a brilliant report.
We use that a lot, don't we? In fact, we use it every month. For every set of accounts, when we're doing month-end checks, we'll do, check the bank reconciliations, all reconcile. We'll check the credit cards, all reconcile. We'll do the VAT reconciliation to make sure what's in the system matches what's on HMRC online. And then you check the fixed asset reconciliation to make sure you haven't missed or overcapitalised anything. And if you get into the routine of doing these on a monthly basis, it becomes a really quick and efficient process that runs fairly well like clockwork. And if you do have reconciling differences, they'll only be in the last 30 days of accounts, which again makes it super quick for you to then go and check. So then we're going to have a look at stock adjustments. So post any stock movements, any losses, any theft, any write-off from your stock account in the balance sheet to your P&L. Have you completed a stock check, and do you need to post an adjustment to the accounts? Now, we wouldn't expect you to do that every month, but once a quarter, perhaps you can do a high-level stock check. Once a year, you should definitely do a full stock check in time for your annual accounts and make sure that you're not holding too much stock in there that you can't use, don't need, and is perhaps redundant. It's also a good idea because it helps you to see what you've got there that's available and perhaps needs to be sold off or discounted to generate a little bit of cash flow and create some space on your shelves.
Then we need to look at the expenses. So have all staff and all of directors claimed for any of their expenses they've incurred during the month. So with this one, it depends on who's involved. Sometimes you can end up just simply forgetting about them, and it does happen. And
well, staff are usually really good at their expenses.
Yeah, it's usually directors are a little bit
worse. Usually a bit rubbish at expenses. But use something like the zero expenses functionality. It's a little bit more expensive than just using the old-fashioned expenses or using some of the third-party tools, but although it's a little bit more expensive, it is really, really good. It's simple to use, and the expenses by far outweighed by the convenience of having a proper expense management process.
Yep. So if you have any expenses where you've paid for them personally, put them through the business, as long as they're, of course, fully allowable for the business, and of course claim for things such as business mileage and work from home allowances as well, because those two often do get missed off.
They do. So once we've checked everything at the top of the list, we're now going to start looking at the profit and loss account. So look at the income and outgoings for the month. Is it in line with your expectations? Are there any big peaks and troughs in the last couple of months of accounts? Look at the trend against previous months. Where there are peaks and troughs, do you need to look into those? Could it be that you've got income or expenses in the wrong months? Could it be that you've had a subscription or an annual cost that's gone in one month that needs to be spread over the future months? Have you received income in advance of goods or services? So perhaps you've billed for something in January that you're not going to deliver until February, so you need to push that income out. If you've got any unexpected lumpy costs that need to be deferred or prepaid, you can prepay them using journals. If you've got any costs that need to be accrued, so for example electricity or phone bills, utility bills, things like that that might be billed quarterly, if you need to accrue those, you can put an accrual adjustment in.
Now, trends in your P&L can tell you a lot. So if you do run a profit and loss report, compare it month by month, look at, say, 5 or 6 months worth of data at the same time, because it does tell you a lot. Because generally, a lot of business activity follows a consistent pattern. So your fixed costs will follow a similar amount. And then when it does uplift and drop down, you'll know why, or at least you should be able to identify why if you're viewing it from, say, a bookkeeping perspective in this case.
So once you've reviewed your profit and loss account, let's go and review the balance sheet. So we've already done things like the bank, the cash, the payments, the loan reconciliations, and we've looked at fixed assets. So let's have a look at the variable accounts in the balance sheet and the accounts that do move. So accruals, for example, we've looked at the P&L side of accruals to make sure that we've got everything that we need in the P&L. But have we got stuff in the balance sheet that we're accruing for, but the invoices have been received? Have we got balances in accruals that shouldn't be there? So the balance in this account should relate to future periods only. It's the same with prepayments. Check that all prepaid costs have been written down to the correct period. And again, the balance in that account should relate to future periods only. If you're accruing for income or you've deferred income, check that you're not accruing for income that may never materialise. Quite often at year end, we provide for an income stream that we think is going to happen and has all probability of happening, and then for whatever reason it just doesn't happen. So that might need to be reversed. Look at the PAYE and NICs owed to HMRC. Are the balances correct? Are you keeping up to date with your liabilities, and do they match the balance in your online account? Again, this is another area where it's really easy to take it for granted that what's in your system and what's in your accounts is correct. But once a quarter, definitely once a year, check that those balances actually match what's in your online account to make sure you haven't missed anything, or that HMRC hasn't missed anything. It wouldn't be unheard of for you to make a payment for PAYE, for example, and HMRC just haven't processed it and allocated it to your account. We quite often have to talk to HMRC because things like that happen, or they make adjustments to accounts because they've been given the wrong reference number and they've meant to adjust somebody else's account and they've actually amended yours instead in error. Now, if these kinds of things happen, and they do happen, quite often you'll get a letter talking about or advising you of arrears that HMRC believe you have on your account, and that's often the first time you hear about that. Now, don't pay that arrears without investigating it first. So we would advise that you keep on top of that by at least once a quarter checking that the balances on the system with HMRC actually match what's in your accounts.
And on the topic of arrears, if you do happen to pay any of your PAYE, VAT, etc., if you do pay it in arrears and you do incur interest charges, if you've been reconciling the bank, it's possible that when you posted the transaction, you might not have accounted for the interest. So if you do review these accounts in your balance sheet, you'll soon spot whether or not you've actually got any interest charges on there,
absolutely.
which you need to write off to your P&L instead.
So let's have a look at our director's loan accounts. Are they in credit or are they overdrawn? An overdrawn director's loan account should be repaid by the end of the financial year. It could be repaid in physical cash, or it could be offset by dividends declared in the accounts if you're making enough profits. Are there sufficient reserves to cover the overdrawn director's loan account? If not, you need to take action now. So looking at the director's loan account is something that we would recommend you do at every month end as part of your month end management accounts process. Make sure that you've got enough in the pot, whether it be reserves to offset with a dividend, whether it be current profits to offset against the dividend, to declare those dividends to pay down that director's loan account. Make sure you keep an eye on that and don't overdraw on your account. At the end of each month, you should close or lock your account, your month-end account, so that you have to think twice about posting new transactions to past reported periods. Now, this is a really, really good control in your accounts. It's not always possible, and you might be thinking, why would I bother if I'm going to go and open the period and post the transaction anyway? But it's a good discipline to get into, and it stops you from making adjustments to accounting periods that are past if you close those accounts.
And it's really important because actually you might accidentally post something in the wrong period if you don't lock it. So you might be posting a journal and you just hit the wrong year. It's changed to 2020 and you put 2019.
Yeah,
it does
happens
happen
all the time.
So
or invoices. The most common thing we see is you just come over for the new year, and then all of your January invoices or number of your January invoices get posted as January 2019. It happens. Yeah. And one way to avoid that happening is to lock your account period down once you've got through your month-end management accounts process.
Because straight away the system will warn you, and then you'll know, don't need to do that because it's going in the wrong place.
And finally, don't forget to keep detailed records of all your transactions. Now, if you're using a system like Xero and Receipt Bank, you've already got that covered because your accounting transactions are in your accounting system, and all of the audit trail is in there too, the PDFs, the contracts, the details that you need to keep. So limited companies must retain their records for 6 years after the end of the accounting period to which the record relates. And sole traders and partnerships have to retain trading records for 5 years from the 31st of January filing date to which the record relates. So the rule of thumb is usually about 6 years. So we hope you found this checklist useful. If you have any queries, please do let us know. Thank you very much.
Thank you.
Bye.
Bye.